So I'm going to start with you first, Vicki. You made a really interesting comment at the beginning, how there is a dire need for infrastructure in this country. So I guess the question I have for you is, given that lens, where do you see the next set of opportunities within that infrastructure market? Is there like a particular sector you're looking at?
So thanks, Nathan. We're very much and have always believed that the best place to get returns for investors is investing in the mid-market. And we do that because in the mid-market you can buy a controlling stake in the assets that you're investing in, which means that you have much more ability to drive returns for investors. So that's the first thing. We're looking for mid-market investors. Beyond that, we're looking to build out our existing portfolio along the portfolio lines that we've already got, because in that way we're looking to build out platforms. We're looking to consolidate fragmented parts of the market, and in that way drive returns by finding synergies by taking out a level of management. So I actually expect that most of our growth opportunities will come through further development of sectors of the market that we've already invested in. And to give you some examples, we're seeing significant growth opportunities in the energy transition space. We're expecting more growth through transport, social infrastructure. They'd be the main three areas that we're looking at the moment, but we're also seeing some opportunities in the digital space as well.
Great, thanks, Vicki. I'm going to switch gears. Andrew, you were speaking earlier about your investment approach, and I really liked how you were talking about sourcing and origination, but can we just go maybe one step deeper? How do you actually find these borrowers, right? It's like, again, they're just not there. And also from the perspective that I imagine when you've got a lot of money, anybody will take your money. So how do you sort of keep the wheat from the chaff, so to speak?
Yeah, sure. We obviously run a very extensive origination platform, and part of that is having people on the ground that have networks and relationships and contacts. And then what we're looking to do is to really use our skill set to understand those companies. Look, there's an awful lot of entertainment and lunches and dinners and all sorts of things that go on to build relationships with companies and different executives. But it's about having a personal relationship and being able to capture the opportunity ahead of any other person or any other party. You're looking to solve a solution. You're looking to be proactive in terms of offering a financing. So when you understand there's an opportunity, it's like, okay, how are the ways in which we can work with you to provide the financing that's going to be on terms and conditions that are acceptable to us? You're 100% right. You get a lot of people that knock on your door looking for financing, but that comes through years and decades of experience in terms of understanding the risk profiles, understanding industry risks that you're looking to take on. But primarily our role is to really understand at a very granular level what drives the cash flow of the business or the project. You're always forming qualitative assessments in terms of management skill, the strategy. Do you believe that their business, their product, their project is going to be viable? And then understanding which companies you stay away from. So our process is we have a team of people that are responsible for origination of real estate transactions, and we have a separate team of people that are responsible for corporate transactions. Each week we go through their pipeline and we monitor what we call our work in progress pipeline. And that means we're always monitoring to ensure that we've got an ongoing pipeline of deal flow and opportunity. So generally we would run a pipeline of transactions, probably around about 10 billion at any one point in time. And across our various funds, we're running around about $2 billion of just natural net recycling of capital through our funds. So a loan you provide for, say, 3 to 5 years, it's going to repay. You need to make sure that you've secured a pipeline of opportunities so that you're not creating a negative cash drag on our funds.
That makes a lot of sense. Justin, let's flip over to you. You started off your presentation talking about how private equity is not as complex as a lot of sort of people make it out to be, which actually leads me to my first question, which is around the risks around private equity funds, and how do you guys manage that risk through your portfolio construction?
Yeah, so I think portfolio construction and active management are kind of core tenets of mid-market private equity, and when we talk about portfolio construction, probably what we're talking about are four things. So one is the asset appropriateness. So the asset we're looking at, does it actually meet the criteria of the manager's mandate? You'd be fascinated with how many managers style drift. So if a manager is telling you they're investing in profitable cash generative businesses generating $5 to $30 million of profits, let's make sure the asset kind of fits that criteria at a minimum. The next piece we look at is the sector diversification in the portfolio. So no one asset will account for more than 20% of the portfolio. We also look at the sector diversification. So the benefit of the vast range of opportunities that Andrew and Vicki and I think ourselves will see is that we're able to carefully construct the portfolio so we don't lean into one sector entirely. So don't take an 80% allocation to education or resources, etc. So that end sector diversification is really important. The next piece is the vintage. So I think the benefit of the portfolio construction and the investment cadence of a mid-market private equity fund is we're not piling into these assets all in 1 year. So you're able to take vintage risk or date the investments periodically so that you don't expose yourself to factors within any one given year. So no more than 30% of the portfolio will be exposed to one vintage. So I think that kind of asset appropriateness, making sure that one asset doesn't kind of occupy a lion's share of the fund, making sure that the sector diversification is right, and then spreading that vintage. I think those are the kind of key risk management factors.
Which is nice, because like I like that stat that you had there where there's actually 9 times more companies that you're shopping for than the ASX, which really then means that this is active. This is not passive investing. This is real active management. Can you just touch a little bit more about how you guys incorporate active into your approach?
Yeah, absolutely. I think so active management, obviously the portfolio construction is really core and centric to that. I think the other things we talk about a lot, and it would be, it'd be the same for Andrew and Vicki, is sourcing, portfolio value creation, and exits or liquidity. So on the sourcing side, I think the active part is, just like a long-only hedge fund, a mid-market private equity manager, a modern one that exists today, they will have a research and origination team embedded within their organization. So we're undertaking really deep thematic and sector research, identifying the market leaders, the private companies in that sector. And then we have an origination model, just like Andrew kind of explained, to kind of go after these businesses. So to give you some flavor, we mapped in the last 2 years around 3,000 private companies, had an initial first meeting with 600 of them, and that led to 20 investments. So there's a real engine room there of active origination. The other pieces, and Vicki touched on it, is the ability to create value in the mid-market is really fantastic when it comes to things like corporatization, making things more efficient, doing accretive mergers and acquisitions. Like these are simple things in essence to large corporates, but in the mid-market, these family-run businesses, that active management means kind of doing these basic things. I think a lot of big companies take for granted very well consistently over time. And that portfolio value creation is really important. I think the final thing is exits, right? So when we go after our mandate, we're very conscious that the businesses we bring to market at the end of an investment period and try sell these businesses, they are, of course, of the right quality benchmark. So, they've got to have the right systems, the right team, the end sector exposure needs to be attractive. But equally, they need to be not too small to kind of have investors disregard them, but not too large that, we're not KKR bringing a $4 billion asset to market. We have a deep pool of acquirers for these assets to create liquidity within our portfolio. So it's a really important final piece.
Thanks. Vicki, we're going to switch back to you. I like the tagline in your presentation: tangible, essential, more predictable. Maybe we can go a little bit deeper into that. So the criteria, this is like your investment criteria, your active decision making. Can you go a little bit deeper into when you start assessing new opportunities? What does tangible, essential, and more predictable look like at a practical level?
Yeah, absolutely. So practically, to do well in infrastructure, you need to buy well, and for us, we need to manage well. So we're looking for assets that we can acquire at a good price, and that we know there are easy wins, we can manage well and boost returns. Now, looking a bit deeper into that, it's not just about, as Justin mentioned, it's not just about buying whatever's available, it's about making sure we're building a diversified portfolio. And so we're looking for a competitive advantage when we first buy, but we're also then looking for it to satisfy a number of portfolio criteria, and also, very importantly, our ESG fundamental criteria. And when we're looking at those portfolio considerations, infrastructure is a really broad asset class, and you can go everywhere from very low risk, fully contracted CPI-linked cash flows up to riskier, more growth-orientated cash flows. And we're looking for a balance between the two. At the moment, a diversified infrastructure fund has about 52% of revenues received through the fund are fully contracted and CPI-linked. And we wouldn't want to see that drop much below that, but we also like that added mix of the more growth style assets, the airports, the ports, that give you your more GDP-linked returns and give you the capital growth within the portfolio. And so it really is important to find a balance between the various different kinds of revenue streams that you can receive from infrastructure.
Perfect. If you'll all indulge me, I have one more question. I can see that we've also got a couple of questions on Slido as well, but I'm going to wrap up with my last question for Andrew. This is something from my side, LIS. So we talk about the role of private debt as an inflation hedge. What's your view of private debt there?
It definitely is. I think at the end of it, it's a very attractive asset class. Primarily, the returns are driven through a floating rate. So when interest rates are rising, obviously the total return is increasing. When you think about it, the return drivers in private debt come from the fees that can be charged to the company, the base rate, BBSY, so the bank bill swap rate, plus a margin, and then a credit margin for the risk, and then any additional lending fees that might be generated over the life of that loan. And so obviously, a big driver of the return comes from fee income and from the ability to gain access to that opportunity before others have stripped out all of the fees. And so as a result of that, I think it presents a very attractive return. When interest rates were low, compared to alternative asset classes, private credit was delivering. Now interest rates have risen a little bit. Private credit's still outperforming other asset classes very attractively. So I think it does present a very unique opportunity for investors, particularly around that inflationary hedge.
Perfect. I'm just looking at the questions here, and I like some of these have been thumbed up. So I'm going to let the mob decide which one we're going to answer. First one's got the most thumbs. We learned from the GFC, if there is a liquidity event in the U.S., we'll be affected regardless. What is the one thing you think may cushion us from such an event? I open it to one of you three. Who would like to take that one?
I'm happy to start.
Go.
I think so. The way we think about this is also a little bit mandate, but a little bit asset specific. So, big liquidity event. The number one thing for us is how does our end sector exposure look? So within the end sectors, kind of how is this liquidity event affecting our end sector exposure? So being attached to sustainable packaging, to IT security, to education, are these sustainable things over the medium to long term? That is a number one check for us. The other thing, and it's probably a private equity centric lens, is I think the real impact here is going to be in private equity managers using a lot of debt within their portfolios. So that debt either creating real issues like banks kind of coming in and taking over, or constraining what they can do in those businesses. So we're servicing interest, we're servicing debt, we're not able to grow, we're not able to transform. So those are two things probably when I read the question I was kind of keen to mention.
I think from my perspective, when markets are dislocated and liquidity dries up, it's a great time to be a lender because you're obviously able to negotiate higher fees, higher margins, and generate a higher total return for any given level of risk. And so, if you think about during the pandemic period, when the government, the RBA, created a lot of liquidity to support companies through a difficult environment, that competition meant that companies had available capital, credit spreads were easing. Obviously that gets withdrawn, the term funding facility is being withdrawn, less competition, margins reflect the availability of financing. And so in times when liquidity withdraws, the power in the negotiation is definitely with a lender, and as a result of that, higher fees and higher margins, higher returns for our investors.
Perfect. We got time for one more question. I'm seeing the lights going up. Vicki, could data centers soon become classed as infrastructure?
I'd say that for many people they already are, and it will very much come down to what the revenue stream looks like from that data centre. We don't currently have them in our in our portfolio. Many infrastructure investors do, and we definitely believe that the digital thematic and their increased need for digital is something that's very much going to drive the next wave of infrastructure investment, and it's something that we have exposure to through other mechanisms rather than through data centres.
Perfect. Vicki, Andrew, Justin, thank you very much for your time, and that's it for us today.